trying to get to a 1% move today, about 400 points or so. Let's give you a little state of the pullback, if we call it that, since the war began. S&P's down about 7%, a little bit shy of that. The issue, as all of you know, is there just hasn't been really anywhere to hide. Bonds have been rough. Yields have been backing up. Yields are down a little bit today, which is helpful. In fact, the 10-year, Steve, is down about 15 basis points from last week or so. The Fed chair was speaking at Harvard this morning and said inflation expectations remain, quote, well anchored. That was important.
Yep.
And you actually saw the market tick up a little bit on that, and yields tick down a little bit. So that's sort of the state of play. How do you see it?
You know, without that statement, Scott, I'm not so sure we'd be in the green except for the Russell today, because we've had other statements, conflicting statements from the Fed, that from other Fed governors, that maybe they're not so well anchored. So I think it's positive, but the question is, will he be saying the same thing if the war endures for a little while yet, as it filters through? So the way I look at the market is in the following: that we just don't know what the risks still are. I can see some headwinds. I think the fact that we're going to have a good earnings season is well telegraphed and absorbed into the numbers, as it was with prior quarters. But we've got a Fed that, for better or worse, only means that it's holding tight and not going to raise. Cuts, I believe, are out of anybody's expectations. So
we begin this midday hour at noon. We are green, as I said, across the board. Look at the NASDAQ. Boy, it's needed that, hasn't it? 1 2/3% higher, and the headlines have been fast and furious this morning. It's really dragged the market around a little bit. We've always stayed green, but the market really got, I think, off to a good footing today, with the Wall Street Journal reporting that the president has told his aides that he's willing to leave Iran without reopening the Strait of Hormuz. Then you had a headline, gosh, feels like a couple hours ago already, that Iran's Revolutionary Guard was threatening U.S. tech companies. You can almost look at an intraday of the Dow for a pretty good look at how the market's traded. And then another headline, there you go, right? And then another headline from the New York Post, Trump telling the New York Post, the president did, that the war won't last, quote, much longer, and that the strait will reopen, quote, automatically after the U.S. leaves. So I think therein lies the trading pattern today. Joe, the economic data was pretty good. I mean,
sure was.
Consumer confidence beat expectations. Gas is above $4 on average now for the first time in a while. So where does all that leave us?
Well, first of all, last day of the quarter, I think that factors into the equation of what we're seeing today, along with the headlines that you mentioned. But, Scott, I also think the market was deeply oversold. Yesterday afternoon was incredibly punitive. The momentum factor was down 2.5%. We saw a lot of the names that had been working coming into the early part of 2026.
It's 12 noon in the East, and we got another pretty good one going. Dow's good for almost 1%. S&P and the NASDAQ are now above that, and crude oil is lower. That's helping. Yields are down. That is helping. You know, Liz, some are, asking the question, is this a short covering rally? Is it more durable? JP Morgan today says it's a bounce, but the technical setup still suggests vulnerability. So I'd say if we get back above the 200-day moving average, I think that would be a sentiment game changer. We're still like 38, 35-ish points away on the S&P from that. Do we need to get above that level again to make people into true believers?
Well, I think there's a few things that would need to happen. From a technical perspective, yes, because it did change sentiment when we dropped below it last Friday. So getting above the 200-day and staying there convincingly, I think, would help from a technical perspective. We're in this weird range right now, again, on technicals, where we're looking at levels that used to be support that are now resistance, right? So we don't want the market to be making lower lows. We don't want there to be a new trend channel. So yes, that would help. However, The risks have not gone away as far as the war is concerned. And last week on Closing Bell, I said this, I stand by it. Unless the Strait of Hormuz is back open and this supply shock has dissipated, we're still in the same situation. I think we all want a ceasefire, but that doesn't necessarily solve the problem. So I think there continues to be this fear and even fragility that the market has not priced in the possibility that things do continue.
Obviously, than what we opened with today. Still down for the NASDAQ and the S&P and the Dow, but we had gone into positive territory even with that spike in crude oil. Interesting stat today from Bespoke. Could be the record 10th consecutive Thursday decline for the S&P. Weird as it is, we'll watch that. Happy Liberation Day anniversary to all of you. I thought we were going to have Escalation Day today.
That was a year ago already?
I can't believe it's been a year ago, but it looked like we were going to run it back in a different way today after that speech last night, which I'm not exactly sure what the intent was, but if it was to calm the markets, it obviously had a reverse effect. But there's been some headlines this morning that have moved the market. I'm trying to figure out, what to do a day after I was asking all of you who are on the show, is it time to think about your post-war playbooks? Now what? What do you do with all that?
So the way the stock market operates, it's already been thinking about its post-war playbook. And I think that's that burst of enthusiasm that you saw the other day, particularly in technology stocks. I think today's reversal is interesting. And obviously not to minimize the fact that there are servicemen and women whose lives are at risk right now, and there's the fog of war. We really have no idea how this will resolve. It sort of reminded me, remember the days when we used to talk about a Fed meeting and we would say, okay, it might be a hike, but it'll be a dovish hike. Because in other words, okay, they're going to do another 25 basis points, but they're going to use their remarks or the release to signal the fact that this could be it, and they're already thinking about the other side of the hiking cycle. And as silly as it sounds to have a dovish hike, the markets took that stuff seriously in the way that they would price the following month or 6 months later where they thought interest rates ultimately would land. And that's what you're seeing in the crude oil markets. You are not seeing the market pricing in some sort of a year-long sustained oil price spike. In fact, it's the opposite. And Trump's remark about we're going to hit them hard in the next 4 weeks, or however he phrased it, the market took that literally. And so you got a crude price spike front month, and then in the out months, it's less severe. And I think that's why you got the rebound that you got ultimately in the S&P. Who knows if that holds? But I think it's important that when we're talking about crude oil spikes, what we're not saying is 110 is the new floor. And everyone's got to learn to live with that. And we now have to take our 27 earnings expectations down to account for that sustained level. Nobody's doing that in stockland right now, and they're not doing that in the crude oil market either.
Yeah, Malcolm, this president's style is obviously at times harsh rhetoric. We saw that again last night. I think the market at this stage is looking to be pacified in some way, that this really isn't going to last all that long. So maybe it was freaked out for a bit. And as we saw already this morning, any headline that moves about the Strait of Hormuz and an end to the effective closure being close is going to